Okay, just type in yes if you can hear my nasally, annoying voice right now. I have a nice cold going. I've never, I hardly ever get sick, and I've been sick twice this winter, and I think it has to do with our newborn kids in the house. I guess when you have kids, even babies, I thought it was just kids bringing stuff home from school, but I guess with babies too, I guess there's germs everywhere. So nobody told me that part. If anybody has ways around that, let me know. Besides the obvious, wash your hands a lot. So fun times, but they're good. So hope you guys are doing well and having a good start to the new year. Lots of volatility here, just insane stuff. I mean, certainly a different start to the year than what we've seen in the last 2 years. Volatility has picked up significantly, so it's really awesome to see. So what I want to do is talk about a couple concepts here. We're going to type it. We're obviously going to talk about the market setups. There's a huge event coming tomorrow with the ECB, and we'll talk about the implications there. Obviously, I'm showing you my Euro chart with all kinds of crazy stuff on it, but we can simplify that one a little bit with the new feature of MotiveWave, which is awesome. And we'll talk about the euro. We'll talk about the implications it has to the other asset classes. Volatility, as I said, has really picked up, which has been awesome. I mean, the Swiss franc move was just catastrophic. I mean that is not an overstatement or an exaggeration, just purely catastrophic. So there was a funny article I just got done doing the video for my research customers, and before we dive in, I want to talk about a couple MotiveWave concepts, a couple Elliott Wave, a little educational tidbits. But first, let's just kind of set the tone here with what's going on tomorrow in the ECB, and really not just Europe, but with the U.S. as well. This was a pretty good article, I thought, from Bloomberg. It's it's talking about the aftershock of the Swiss move, and the point of the article is just saying, boy, a lot of market participants are trusting billions and billions of dollars in positions on policies set forth by central banks that they really don't have a full understanding of what's going on here. So it's a reminder that a lot of asset managers are going to check their positions and just really do a gut check and see if they're in the right trade, and that has a lot of implications as to what's going to happen tomorrow. So obviously the spark was the Swiss move. It surged as much as 41% against the euro, and it was a good reminder of the risks of following the herd. And the article goes on to say that the dollar long position is just massive, hugely oversubscribed, and what they call a fully crowded trade. So that's the beauty of Elliott. We're going to get in there and take a look at the euro chart and figure out, where are we? The saying I like to use with our clients is trade what you see, not what you think. And it's very easy to think that the European Central Bank is about to unleash a bazooka of quantitative easing on the economy. The Fed is moving towards a rate hike, and those are vastly diverging policies that really point to euro moving down on a fundamental point of view. But then there's a time where you got to sidestep that and look at the charts and trade what you see, not what you think. And that's where Elliott is just wonderful. Because Elliott, what you do is you take these fundamental news stories and factors that market participants are throwing around, you kind of mix them all up, you throw them in a big mixing bowl, and then you put them through the grinder that is Elliott, and out comes a nice piece of sausage that it tells you if we should be moving higher or lower based on where we are in the wave count. And what I mean by that is, everyone is talking very, very bearish on the euro, very bullish on the US dollar, and positioning certainly indicates that. But when you step back and you look at where we are in the long-term charts, you say, maybe it's one of those times where we need to start stepping ahead of the crowd. A couple other funny things in this article. People have to be reassessing what the positions are. John Lewis. This part was pretty funny. People are betting billions of dollars on the kindness of strangers, people they'd never met whose names they couldn't pronounce. I thought that was pretty funny. So it's a great point he makes. And then this guy goes on to say, and I've said this many times on TV before, on CNBC, and with our clients, a small downturn in the U.S. economy, just enough to make people say maybe rates aren't moving higher, but the Fed's on hold. That could take some of the sheen out of the dollar shine. Okay. And I've said this probably 15 times on CNBC, with the volatility around the world, with China slowing, with Europe basically on the verge of collapse. How is the Fed going to raise rates? I just don't see it. And if the market finally latches onto that, then you might start to see, as that guy just said, some of the sheen on the dollar shine come off. And that is something that matches up with what we're seeing. Trust me, I love this dollar trend. I really want to continue to buy the dollar. I'd love to see euro fall apart. I think falling markets produce great volatility and great trading patterns, but just not seeing it right now. So that's the first thing. Europe's important tomorrow. They're expected to announce anywhere from 500 billion to 1 trillion in bond purchases. So the European Central Bank is about to officially kick off their bond purchase. So, you know, I'm a technical trader, but as I've tried to describe to you just now, you know, I love to watch the fundamentals as well, because when you kind of grind them up and put them through the sausage maker of Elliott, you can figure out what you want to keep and what you want to throw away. And right now, it's saying we want to grind up and throw away the bearish euro, bullish US dollar factors for now, because I think the move is extended. I don't think it's an all-out reversal, pardon me, but the primary count that we're tracking here, pardon me, on the euro daily is this. And let me just hide some degrees. And I know Tony's listening. I haven't told you yet, Tony, but this hide feature is awesome. I love it. And I can just very quickly show you all the level of degrees that I want to show you in the wave count. It's great. So thank you for that. But what we're seeing here from the May 2014 high is a nice red 1-2, red 3-4, and we've begun to touch the upper end of wave 5 support in the euro, ranging from 115.75 down to 111. I see this as just an A wave, and we should then, according to textbook Elliott, rally back to at least the 38% retracement, which is 124. And what's interesting is, I think probably 5 traders out of 100 expect a move back up to 125 post ECB. And I've been in the markets long enough to just know that that's how the markets work. However, they can basically screw the most amount of people, they're gonna do that. And I feel like this long dollar position is a little overextended. So wouldn't it just be the market's way for the ECB to come out and announce 750 billion in bond purchases, and then have the euro rally a couple hundred points? It's tomorrow is wild. If you don't quite, grasp the significance of tomorrow's ECB announcement, please do. It's really, really important. We're not carrying any positions. I do have the last third of a gold position that we'll talk about. We just took 2/3 profits yesterday on a long gold, which is a volatility hedge heading into this ECB announcement. You're seeing gold move higher, seeing bonds move higher. It's a really fun intermarket kind of environment, kind of a macro environment. You're seeing great movement in the dollar, movement in gold, in crude, in bonds. Stocks right now, put it plainly, are horrible. Stocks are not what you should be trading right now. The S&P is just horrible right now. The movements in currencies, commodities, and bonds. Great news is we have wonderful ETFs to trade to take advantage of that. So if you're not involved and you're only banging away at Apple and Google and Tesla and GoPro, you need to branch out into the macro environment, because it's great, because you have all these fundamental stories, as I've said, all little bits and pieces that make up the sausage. You can all put them in, grind them through the Elliott Wave grinder, and figure out nice trends and define risk and reward, and really kind of play on that global stage, if you know what I'm saying. So it's pretty fun. You can trade just like a global macro hedge fund manager with the ETFs that are available to us now. So enough sauce. Actually, I'm getting hungry now. I kind of want sausage for breakfast. Okay. So that being said, it's important. I am tracking an alternate count, and those of you who are experienced with Elliott know that you do need to track two wave counts because you always have plan A, plan B. Those of you who are new to Elliott or heard people poo-poo it because it doesn't work because you have two or three different wave counts, clearly doesn't understand having a plan A and plan B and going into battle. The analogy I like to use is, how many great generals in history went into battle with one plan and said, this is the way the war is going to unfold, and I have no contingency plan. Obviously, any kind of general like that is going to get destroyed. So you always have plan A, plan B going into battle. You pick the most likely plan, and if that plan doesn't work, you very calmly, quickly cut your losses, cut your positions, contain risk, and then just quietly move over to your plan B. And that is what Elliott Wave is. It is not a forecasting methodology. Too many people mistake Elliott for a forecasting methodology. It's a horrible forecasting methodology, but it's a wonderful trading methodology, and there's a big difference there. Okay, so when you start working with primary and alternate counts, that's when you can really harness the power of what Elliott Wave has to do. You have to be able to thrive in subjectivity, and that's what trading is subject. It's a big subjective, what I call conditional statement. If A happens, then do B. If C happens, then do D. That is all trading is, and Elliott, in my opinion, is the best methodology out there to do that. So the question that I'm currently grappling with in Euro heading to the ECB is the location of this red 5. On the left chart is my primary. I am coming in actually bullish. I'm not putting positions on in spot. I am looking to do it in options via the FXE call options or selling puts below depending on where volatility is. A lot of people who blew up accounts in the Swiss franc move were because you're holding a futures or a spot forex contract. I'm a big fan of spot forex. I have a long history with spot forex, but there's times where it's better just to be holding option premiums. That if there's a massive, gigantic, illiquid move where there's no liquidity to fill your stop, if you're holding an option contract, all you're going to lose is what you paid for the option contract. You could buy one contract with the FXE for probably $150, and that's all you would lose. Those people who, unfortunately, and I hope nobody was on the line here, who had a Swiss franc position on, if you're in there, I mean, you could lose your entire account. If you're holding an option premium, can't happen. So the only way I would look to do this tomorrow, because FX markets have been so wild, is just by holding option premium, and that's all that's at risk. I am considering going long euro. And here's the reason. As I said, I don't know where this red wave 5 comes in. Either it's at the low right here, and we're going to rally to a much larger extent than anyone expects. A 38% price retracement of the 5 wave move from May 2014 puts us at 124.27 in the spot euro. 50% retracement, which is still a conservative, not in a B wave. B wave, that's your average target, would be 127.26. So what works with that is we also have two prior wave 4s, which tend to be targets on retracements. So one, I think we're either rallying like over 1,000 pips to complete the B wave, which then sets up another 5 wave move down in the C wave, which then brings us down to parity. But I think we do hit parity, but as I just said, we do it from higher levels, not current levels. That's my plan A. That's what I'm going to war with tomorrow. If I'm wrong, I hope I'm wrong on this count. I hope I'm wrong this way, in that wave 5 is not yet, red wave 5 is not yet in play. Okay, so all we're doing is we're extending this wave 5 lower. Now, all of your trend waves, 1, 3, and 5, must have 5 smaller waves. So the way I'm looking at this is a wave 1. Here's your wave 2. Here's your wave 3. And I'm thinking, okay, we're starting to get a little rally even this morning. I'm sure there's going to be shorts covering ahead of the ECB tomorrow. We should be moving up in wave 4. Okay, this is a daily chart. From 116, a common stopping point would be 0.618 of wave 2, same degree wave 2, or 100% of wave 2. So that puts us up to 116.58 or 117.81. Okay, so what I'm saying here is euro rallies from current levels up to about 118 on the blue count, and it also rallies up to about 118 on the red count. The red count says we're going to stop and then head lower. Okay, so what that means, guys, is I have two different wave counts, but both point to the market moving about 100 pips higher from current levels. That's what you call employing Elliott. That's what's called putting the probabilities on your side and not knowing what the wave count is. There's a big difference that not a lot of people understand. Okay, there's too many people get caught up saying, well, this is what must happen in the Elliott Wave world, and this is the only count that can be. And no, that's not true. I'd love to have three different wave counts, but they all point to the market going in the same direction. That increases my conviction in the trade. Yeah, Brett, great point too. German DAX is up on the highs. Yeah, German DAX is breaking out. They love the liquidity coming down the pike. So, all right. So that's Euro, and kind of what I want to talk about here today, in terms of education, would be let's talk about wave fours. And the euro is a nice segue. And actually, this pattern is happening in euro dollar. It's happening in euro yen, and it's actually starting to set up in gold. And then another one I want to talk about is a setup I'm looking at over in the stock option side, which is EWW, which is the Mexico ETF. Mexico ties in very well with crude oil. I think crude oil is in a fourth wave as well. So we're seeing a lot of fourth waves, and I think we should spend some time talking about fourths. All right, so let's kind of lay this out here and show you what I mean. And again, you got to excuse me. I'm having a hard time breathing here, so I'm sorry. It sounds so terrible. But fourth waves are incredibly important because they are quite easy to identify. And wave fours are easy to identify. They can be tricky to find the end, but once you do find the end, you have a relatively good idea that you're going to rally in a fifth wave. The way you can identify a third wave and a coming fourth wave is this. You want to find a move earlier in the chart that rallied from a significant low. Okay, so we had a long downtrend here. You want to find something that identifies or counts as a little five wave move up. All right. Then what you want to do is find a second wave retracement. And what you want to happen here is you want to see a three wave move. So the first thing after a long decline is you want to see a five wave move up. And let me just do this, show lines. Five wave move up, followed by a three wave move that does not break below the origin of your five wave move right here. Okay, so you want to find something that stays above 76.84. Usually your second wave will get back into the 61% retracement. Sometimes we get down to the 786 retracement. So if you see a three wave move down into one of those two fib levels, we hold that zone and then begin to move higher and break above the B wave high here. Then you say, okay, I think we could be in business here. You absolutely can look for wave three longs here. All right, it's not the point of what we're going at right now, but once you get above 81.13, you could look for long positions with a five wave move up, three wave decline. You break above 81.13, you could be long here with a stop below the 786 retracement. I don't believe you need to put a stop at the lows. I think 786 retracement is fine. Most second waves shouldn't break below 786, so you could be long here, stop below 786. Wave threes should rally in five waves, and there's a key point here in the third wave. That's going to be the time that's going to be the length at which distance traveled in wave one will be equal to the distance traveled in wave three, and that's a key stopping point. So let me just kind of highlight him a little bit. So distance traveled in wave one is that distance right there from low to high. Okay. I'm just going to take that point, and I'm just going to take this line and just drop it over here. Okay, so the time that ongoing wave three travels the distance of wave one, that's a key decision point. Why? Because that is, if I go to ratio analysis, 3v1, that's the point that is the 100% relationship of wave one versus potential ongoing wave three. If you get through that 100% and keep going, then you have a pretty good idea that you're in a third wave. If you fail here at the 100% and start heading lower, then there's a good possibility that this was a three-wave correction and this downtrend is still in play and you're heading lower if you fail at the 100%. But if you get through the 100%, get through the 1272 or to the 1272 and get up to the 1618, then you have a pretty good idea that you are in a third wave. Okay, so let me just make that a different color. Properties, format. Let's make him orange. It's fine, just that little extra price moving up to the 1618. That gives you a pretty good conviction that you're in a third wave. Now, only after you can count 5 waves inside of that third wave will you have the conviction to say, okay, this guy's probably over. Now, here's where the fourth wave comes in. All right. The great news is fourth waves have a lot of information earlier in the count to help you figure out where and when wave 4 is going to stop. First thing you do, I don't even care, I'll just leave the 3v1 over there. First thing you want to do for a fourth wave is I want to know right away distance traveled in wave 2, and I want to project it down from the distance traveled in wave 4. So we'll go like this, ratio analysis. You right click, you just click on the degree you want to study, which is this red degree. I don't want to study this degree. I don't want to study this wave 4. I want to study this wave 4 because I want to figure out how far this is going to last. So the first thing you do is you can right click anywhere on this dotted line, go ratio analysis 4v2. Somebody's texting me. Let me make sure I'm not. Okay, perfect. Just make sure if I'm screwing something up, people usually trying to grab me on IM and saying, Todd, you're not showing your screen or something's wrong. So, okay, 4v2. Sorry, one more second. I'm on the webinar. Okay, so back to this point. So first thing you want to do is you want to look at distance traveled in wave 2 compared to ongoing wave 4. That's the first thing I want to do. The levels you want to keep in mind are 0.618, 100%, and 1.618. Those are your key levels. Okay, so then you're going to right click and pin it, and then we're going to do the next study. So the first one we want to do, let me just write this down, and I think this, I know this is basic for some of you, but for others, I think it's going to be a help. Step 1, you want to do distance traveled in wave 2 compared to ongoing wave 4. Okay, that's the first step. The second step, oh, you know what, and we're going to do it in terms of MotiveWave. The second step, step 2, right click and pin it. Okay, so I right clicked, I already pinned the ratio down, because what's going to happen when we do our next wave 4 study, if you don't pin it, this wave 4 v2 is going to disappear. So we're going to go over here, ratio analysis, and next thing we're going to do is rather than study the distance of wave 2 compared to wave 4, I want to take the next piece of information which is available to us, which is distance traveled in wave 3 compared to wave 4. This is where your typical Fibonacci retracements come in. You're studying a trend wave to analyze a corrective wave. You could use it down here just like we did a 2v1. I'm doing a trend wave to calculate a corrective wave. That's where retracements come in. So I'm going to click on the degree I want to study, go down here, ratio analysis, and go 4v3. So now what you're seeing, okay, interesting. You're starting to see some clustering of support. And I have these color-coded in the trading analysis version of MotiveWave, and Tony has them in the traditional version as well. Blue for me means earlier targets, meaning higher targets in the case of a downward correction. These are your minimum targets. Green is your ideal, and orange is your kind of lower or outer boundaries. Okay, so now we start to have a zone of fib support. Okay, now what we did with price is we're actually going to do the same thing. We're going to do it in time. Okay, we're going to define when this and how long this should happen. Okay, distance traveled in wave 3 compared to ongoing wave 4. Fib retracements. That's step 3. Okay. Now, the same thing I want to see happen in terms of not just price, which is 2 compared to 4 and 3 compared to 4 in price, but I also want to do it in time. Because as option traders, that's very important to understand when this should happen. So you want to go over here, you want to go time analysis. Same thing, 4v2, 4v3. Okay, instead of ratio analysis, you want to do time. We're going to study the x-axis. And I want to know 0.618 all the way out to the 200%. Right click, pin it. Okay, so let's just copy this. So that's going to be step 4. And instead of distance traveled, we're going to go time elapsed in wave 2 compared to ongoing wave 4. Copy. Step 5. Right click and pin it. Already done. And just keep going. Okay. We're going to do the same thing that we did with price. So it's time elapsed in wave 3 compared to ongoing wave 4. Fib time retracements. Okay, so same thing. Right click, time analysis, 4v3. And using these yellow dots, you can move these guys up and down. Okay, and I lost my questions. Let me just make sure I get my questions there. Attendees, polls, dashboard. Sorry, if you guys are asking questions, my questions thing disappeared. Let's see. Chat. No idea where it is. Sorry if you guys are asking questions. I'm not being very good at this. Oh, here it is. Perfect. Okay. You guys, it looks like you're doing okay there. All right. So now we've done a 4v3 time elapsed in wave 3 compared to ongoing wave 4, fib time retracements. All right, perfect. So you're looking for a clustering of those zones. And basically what that does is it says this EWW, wherever it is, we should expect wave 4 to end between 86.38 over here and possibly get as low as 83.5. It should happen between, let's say, December 14th and January 20th. Okay, so now we have price and time zone in which wave 4 should exist. So what I like to do is take a box, and I like to take the vertical parts of it and start it on the far time ratio, and then put it on the later time ratio, the earliest time ratio here, and then the later time ratio there. Then I like to adjust the horizontal to catch the higher price support down to the lower price support. Now, guys, you have a zone where wave 4 is targeted to end. As an option trader, that's extremely useful because, you know, a lot of strategies that I like to do coming into a wave 3 after we've gone through this process is say, okay, if we expect price to chop to the downside going out this far, so this was December 14th down into January 9th, you know, with 3 weeks of expected range-bound activity. So if you wanted to put iron condors on, short premium, short straddles, short strangles, great time to do it is just after the completion of a third wave, because that would be the point at which implied volatility is the highest following a third wave. If it was a stock market rally, maybe not the case because stock market rallies tend to put volatility very low. But if you're talking crude or you know, commodities or bonds or anything like that, or you know, even stocks, you know, sharp moves up can get a higher implied volatility. A great time to put short premium strategies on is here. If you're not a option trader, better to wait for the wave 4 completion down into the zone to then begin looking for a wave 5 move higher. Okay, the good news is there's only 3 corrections in the Elliott Wave world. All right, so you're looking for one of 3 corrections. So step 7 is to outline fib price and time expected support zone. And I'm talking support in terms of price and time. You can have time support. Okay, these are time support levels. Outline fib price and time expected support. And simply wait for one of the 3 Elliott corrections to unfold. Okay, and the good news is, as I said, there's only 3 kinds of corrections in the Elliott Wave world. There's an ABC zigzag, which looks like this. Oh, that didn't work very well. Oh, it's trying to connect it to price. Down on the actual price chart. Sorry, it's trying to snap it onto the price down there. I don't know how to do this here. Decompose. Yeah, I can just do it like this. Yep, there we go. Let me just outline. This is a little wave 4 cheat sheet. I hope you guys don't mind me taking the time to do this, but before we, I'm almost done with this little section on the little educational section, and we are going to apply this to a couple markets and show you how to set up trades with your newly acquired wave 4 information. Okay, so let me just do this. Preference show lines. Preferences show lines. Okay, so this is what you call the zigzag, and that's correction number 1. Correction number 1, that's the zigzag. It's kind of a goofy name. They named it back in the 30s and 40s, so I guess it was cool back then, but I know it's zigzag. It's got a goofy. The other kind of correction is called a flat, and it unfolds like this. Degree increase, decompose correction, decompose impulse. I'm not going to get into the specifics of these of inside the waves. I'll leave that for another time. But you can just kind of use this for a reference. Show lines. That is correction number 2, which is a flat. And then the last kind of correction you're looking for, very traditional, you guys have all seen them, are your triangles. 5-wave move, higher lows, lower highs. Pretty straightforward. Correction, decompose, correction, decompose. Okay, let me just do this. Maybe I can do it all at once. Preferences, show lines. There we go. Perfect. Analysis, show. Okay. So there's your third kind of correction. Now, in your 4th wave zone, as I just laid out, you're looking for one of these corrections to unfold inside and meeting your price and time targets. Okay. Now, what happens if some of you are a little bit more advanced in Elliott is if you get one of the corrections and it unfolds like this. You get a little. Let's say you get an ABC zigzag. You get a little A, B, C, and it does that real small. You haven't met the time requirement. You've just touched the upper price requirement. What that means, that's a zigzag. That's an ABC zigzag. High, lower, low, where a flat is just going sideways and a triangle is definitely going sideways. If you get a little ABC zigzag here, you'll know that this correction is doing what they call complex, which means basically you're going to need another one of these corrections to unfold. Okay, so you need an ABC. So that means you need another ABC, another flat, or another triangle to fulfill your price and time targets. So that's when you start seeing WXY, which is complex. By outlining your fib price and time to start, you know where the wave 4 should complete, right? Again, let me underline that. If you get a little ABC and it's shallow, both in price and time, then you'll know this is just the first correction, and we should go into another complete correction inside of here. And only then do you have the confidence to say, okay, we're off and running up in wave 5. Okay, so that is your Elliott cheat sheet there for fourth waves. All right, and as I said, let's just let me take a screenshot of that. I just want to keep that. And guys, a lot of people ask me, how did you learn Elliott? And it was just like this, taking something like this. Somebody did this for me. I screenshotted it, printed it, and just pasted it right next to my computer, and I looked at it for about 2 years. And you absorb it, guys. It seems pretty tricky, but it's not. You study it for a little while, you guys will get it. You're smarter than I am. Definitely, a lot of you are smarter than I am. I know that for a fact. You'll get it. It's not hard. It's just applying the rules. Okay, so um, let's take that same concept. I mean, this is going to be a bearish example, but let's just do what we did in Euro. This is the alternate count as we just looked at, but let's go through the same process. So let me do it this way. You know what? Let me pop this out. Actually, it is out. Okay, perfect. All right, so I'm going to leave the chart that we're going to work over here, and I'm just going to follow the steps, 7 steps. Number 1 for wave 4, distance traveled in wave 2 compared to ongoing 4. That was already done, but I'll just do it again. Ratio analysis, 4v2. Number 2, right-click pin it. Number 3, distance traveled in wave 3 compared to ongoing wave 4 fib retracement. So you just click anywhere in the dotted line. Go ratio analysis, 4v3. Okay. I should put another intervening pin it in there, but that's okay. So now we have a zone. Okay, we're looking for the green and orange levels and the blue levels. There's your zone. Step 4, time elapsed in 2 compared to ongoing wave 4. So I right click it. I go time analysis. Oops. Time analysis 4v2. And bring in all your ratios. And you got to spread it out here a little bit. Right click, pin it. Step 6, time elapsed in wave 3 compared to ongoing wave 4, fib time retracement. So go again. Time analysis 4v3. Okay, and you can move these around. I want to get the 38% retracement in there, which is there. So you just kind of left click on this yellow dot, left click and hold and pull it over. And now you're looking for agreements. You're looking for where these guys kind of intersect. So now you have a price and a time zone. I like to go over on MotiveWave and pull over this box, which is in, I think it's, where is it? Right there, under basic components. And we'll start the left vertical at the earlier time, and then we'll put the right vertical on the later time. We'll put the upper horizontal at the upper price and the lower horizontal at the lower price. And now you have a target wave 4 zone. Okay, so that begins from January 26th out towards February 13th between 116.5 up to 120. Okay, so this move that we've seen in the euro is just touching the bottom part of your wave 4 box. Okay, now what we need is one of these patterns to unfold inside of this zone. And once you can identify one of these patterns inside of the zone, that's a trade. Okay, that's a trade. That is euro. Let's talk about gold. Sure, Andreas. I'll talk about crude. How am I doing? 6 minutes. Okay, perfect. Let me just get rid of that. Get rid of this. Let me talk about gold. We'll do that pattern real quick. We have gold on in the service. We are long a GLD call spread. We just took 2/3 profits yesterday. Where is gold now? Oh, it's at 1302. Thinking wave 3 is about over. So let me just bring this guy in here. Might take a second because I'm screen sharing. It's showing on the daily, but not on the intraday. Come on, baby. TradeStation's having a hard time feeding us data here. All All right, I can do it on the daily. That's too bad. All right. Okay. So here's the daily. And gold, we did a call spread, and we have GLD over here on the left, and the ETF, and we have the futures over here on the right. The breakout above wave 3 was 1240. We got involved right around there, and we've been long up to this point. We're looking at a wave 1, 2, 3 inside of here. Okay, so let me pull some of these fibs out of the way and kind of clear things up here. Let me just make sure it didn't. Oh, there it is. Finally came in. Perfect. Okay, so what I want to do here on gold is go through the same process, but we are working inside of green 3. Green 3 is a trend wave, so we'd expect 5 smaller waves. I think we have red 1, 2, red 3, and we're beginning to top out in red 3. Okay, so red 3 looks like this. And what's interesting is we're right up at the 1.618. So what that means is we're doing 1, 2, and you've taken the distance. We're through the 100%. So the 100% is that key level. That's the time that distance traveled in 1 is equal to distance traveled in wave 3. That's 100%. That's your minimum target. And for a good third wave, you're looking to get up to the 1.618, which we've gotten through. So we took 2/3 of a profit on a 120, 125 call spread. We bought the 120s over here on the left scale of GLD, sold the 125s, because that is the objective. We got through this breakout. We thought we'd get through the 100% up to the 1618, and we took 2/3 profit. So when we open here in 2 minutes, we'll be at max profit on the short. I still have some GLD just long stock. I'll look to scale out of more of that, but we're at max profit here in the GLD. We are now expecting a wave 4 to unfold because we are through the 1618 compared to wave 1 up from 3. All right, 200% can come into play, and in a real extended move, we could get up to 1322, but it's not common. So with the wave 4, guys, go through the same process. I think wave 4 is going to unfold. You do wave 4v2 price, 4v3 price, wave 4v2 time, wave 4v3 time, and that should give you the low in gold. The wave count validation is all the way down here at the wave 1 low. Okay, but because red 4 should not get inside of red 2, but we also have technical resistance that was broken here at 1240, which is a real significant level. I don't think we'll get back below there, so we're looking to be out of gold. Crude oil is also, and I think, to be a fourth wave. Same situation. Okay, wave 2 was from, I think, September 14th up to September 30th, so about 2 weeks. Right? If you look at it over on the daily, which I can show you, that September move, you might say, well, why'd you pick that of all of these corrections? If you look at it over on the daily, which I'll show you in a second here, it's the only one that really sticks out as anything meaningful in terms of a correction. So what I mean by that is here's the crude oil on the daily. This is the only correction that took any kind of real time here. This was about 2 weeks. Everything else was about 4 or 5 days on the way down. Okay, so it's real shallow price and time in wave 2 because crude oil is so weak. So wave 4 shouldn't be very aggressive as well. So we're thinking much like euro that should bounce, much like gold that's been rallying. I think crude oil should bounce. And if you overlay crude and euro, you're going to find this is one of the tightest relationships out there. Okay, FX. I think that's the symbol for trade. I hope that's right. No, you are no slash. There we go. If you overlay euro and crude oil, watch this. This is how you also refine your Elliott Wave count, is by doing Elliott Wave analysis on correlated markets. Come on, get in there. It's being very shy. I'll let that work here for a second. Okay, so wave 4 should be unfolding back into the mid 50s. All right, if we get onto an intraday chart of crude on the same count, there it is, finally pops in. Euro, dollar in blue, crude oil in black. They are pretty tight. Not perfect, but pretty good. Why? Because the dollar and crude oil are inverse. You guys know I started with the euro, and the euro I think is bouncing, and that matches up very well with the Elliott Wave count in crude oil. Okay, so daily, let's get on to a 4-hour, get inside of this green 4 a little bit. There's green 3 on the 4-hour, matching up with green 3 here on the daily. And I think crude oil right now is actually a buy because, again, your wave 4 fib price and time objectives. If you did 4v2, 4v3 price and time, I have 4v3 on there. Let me do 4v2 right there. Okay, there's 4v3 right here. Let me get the time out of the way. That's that. Let me get the 4236 in there because wave 2 is so small. That's his fib from a different count or from a different degree. So we'll pin that. Pin that. We'll do time analysis. We've done 4v2. Let's do 4v3. And 4v2 disappeared. Awesome. I'm pretty sure I had it pinned. Time analysis 4v2. There we go. Okay, now we have some agreements. Let me get 1618 in there. Okay, perfect. So now, guys, we have some very early timing coming in here towards the end of January, but we really start getting into the meat out here in the first and second week of February. Okay, so we have the price zone from here to here, from about 50 to 58, and the real timing comes in the first week of Feb. So what I like to do is push all of these wave counts out to give this wave 4 time to marinate. I'm also looking at some short option premium strategies based on the expected wave 4 length in here. Okay, so we should really be lasting until the 1618, until the 38%, out until the first and second week of February, which is a solid 3 to 4 weeks away. So, if this thing holds, I think we're in good shape. We should not break below 44.25. Okay, 47.24. I don't think I want to be long. I think I'd just rather be short premium. Okay, getting down to a 3-hour, there's pretty good evidence that this is correct because down in the 1 hour, look, you can count 5 waves up. You have 5 waves up, and we're looking at a 3-wave move down. If you start to get another 5-wave move up, and you say, all right, pretty good idea that we are moving higher inside of this wave 4. So I am not, I'm just not bearish crude right now. The reason being is this is long-term fib support. We had 5 waves up, we have 3 waves down, we have euro dollar confirming it's a correlated market with the same wave count. Andreas, really good, really smart. I was just thinking the same thing. It's possibly triangle. Yep, I was just thinking the same thing. If that's what you're talking about, really well done. Yep, it very well could be a B-wave triangle. Then let me just bring over that screenshot. Just kind of show you guys. Oh man, where'd it go? Snag it, snag it, snag it, snag it. Oh, up there. Okay, triangle looks like this. It's a 5-wave move. A, B, C, D, E. Each of the waves has 3-wave subdivision. ABC, 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 ABC. Looking at crude oil, A, B, C, D, and one more down in E, and very well could be a triangle. If so, really good eye. I mean, guys, if you're new to Elliott, I've got clients who started out pretty well, decent, not great at all, and some of them count better than I do now. So you can learn it, trust me. A, B, C, D, and then one more push down on E would complete the triangle, and then we have another wave 5 move up. Brett, you're one of them. I love it. I have guys who subscribe to my servers, and some of them are better Elliott Wave counters than I am. But it's just I love it. So, all right, guys, I hope that helps. There's a lot there, but you guys now know how to identify wave 4s, and we've applied it to the current market. So, good luck in ECB. And you know what? The best part about it is, guys, you are pre-planned traders now. You have planned your trade. Now, what you want to do is trade your plan. which is the motto of my company. That's why Tony at MotiveWave put together such a nice piece of charting software together to allow us Elliott Wave servers to do it. And as I said, it is a trading methodology, not a forecasting methodology, because there's points at which the trade is right, there's points at which it's wrong. Will we be right all the time? No. I'm hoping to be right about 51 to maybe 55, maybe 58% of the time, and then wrong the rest. But the most important thing is you've planned your trade, and all you got to do is trade your plan, and that's how you prevent and guard against emotional, reactionary decisions in the market that can destroy your trading account. If you trade your plan, you're very unlikely to make a rash trade, kind of a revenge trade that can really hurt your account. So if you can trade your plan, you can keep yourself under control, which is not easy to do in the markets. But using these tools, I think that's the way to do it. My pleasure, guys. Thanks so much. No, no, not bad English. Great work. Um, well done on Netflix. All right, guys. Sorry I didn't leave any time for questions, but I knew if you have anything, I'll hang around here for a little while if you have any questions. But I'm going to stop the recording, and hope you guys enjoyed it. I'll have this archive up here a little bit later today, and hopefully you guys enjoyed it. All right, guys, have a great, great trading day. Let me just stop the recording now.